into 2016. Oh, what a year. I'm your moderator, Jim Jockle. And it is the coldest day of the year of 2016 here in Midtown Manhattan. And joining me today for a discussion on taking a look at the outlook going into 2017, Sanjay Sharma, founder and chairman of Greenpoint Financial, and Jen Beckworth, managing director of financial institutions. Gentlemen, welcome. So today in this discussion, we're going to try and dig into what is this. Obviously, we saw a rate increase this past Wednesday from the U.S. Fed, and we're poised for 6 more. But I don't think the picture is as rosy as right now as some of the markets feel. So today we're going to talk a little bit of what is that global economic outlook. What about the zero negative interest rate environment that we are experiencing across the globe? Also, we're getting a little bit more clarity around what a U.S. Treasury is going to look like under President-elect Trump. So lots to get into. So Sanjay, let me start with you. What is the global feel right now?
Global feel around the world from a macroeconomic perspective is demand, demand, demand. There is lack of demand in Europe. There's lack of demand in Japan. There are questions about demand in China, demand as in consumer demand that leads to business demand. In China, there's talk of a bubble that keeps going on, even though we don't see some kind of precipitation of that. Brazil is facing demand pressures because it's commodities oriented. Russia is facing demand pressures. And so it's all about demand. Why is there a lack of demand? First of all, there are demographic factors in Japan. There are demographic factors in Europe with aging population and lack of immigration. On the second hand, while we love productivity, increase in productivity, every fraction of a percentage leads to efficient, improved production methods and job all the job losses or be naturalistic about it. But the fact is that increasing productivity leads to a lot of job losses. Job losses lead to lack of demand. So there's risk that we might be in this cycle where we are increasing productivity every day, amazing technological developments. But the issue there is that it is leading to a more stagnating demand. That leads to lack of inflation, and central banks are puzzled, or will be puzzled, or always puzzled about this phenomenon. Now, you can have negative interest rates. You talked about negative interest rates in the beginning, and so we have now prevailing negative interest rates. And here's my pop quiz. Negative interest rates have been prevailing by the ECU or the ECB for 2 years now. And it was started surprisingly in 2014. Have stabilized the growth at 1.6% across the Eurozone, but negative interest rates have other consequences. Other consequences are bank profitability. Bank profitability goes down, there's no accumulation, and that then leads to lack of lending. And so zero interest rates or negative interest rates have their own effects.
So, Jim, let me turn to you. Let's stay on negative rates just for a moment here. So, if we look at, I think it's 9 of the major currencies are all negative. If you take into consideration the Swedens, the Japans, the 10-year are negative. Even the 10-year notes are negative. Data maturity is going into 7 years. Have limited tools in their arsenal. So, what's the thought process of the commerce happening in the U.S. in terms of this spike? How is that going to play out as well?
You've seen a number of different things happen in the U.S. that are going to be translated, I think, over time into the rest of the world, right? So in the U.S., we now have a new administration. The IMF report looks like old news compared to the press reports that you see now. We have the fiscal stimulus that's going to be coming out. We have a strong dollar. We have a Dow Jones that if we hit 20,000 a day is going to be 11.5% higher than it was when Trump was elected. And we have our second rate hike since the Great Recession, with a projection that we're going to have more rate hikes coming up. We have a flattening. We even have a higher 10-year over here. So the question is going to be whether we can, in the U.S., export some of that growth overseas. We're starting to see a change not only in the fiscal stimulus side, but also in the regulatory side. And that's not just in the U.S., but that's globally. So if you look at the beginning, this is a reflection of 2016, I know that we were going to start with. And if you looked at the beginning of the year, you would have said, wow, this is, 2017, 2018 are going to be continuing years of implementing all this regulation that we put in place. So we have the Dodd-Frank that's coming into force. We have Basel 2.5, Basel 3 that are coming into play. We have the FRTB that just was announced earlier this year and that comes into play in 2019. So there's a lot of constraints to the Volcker Rule, a lot of regulatory constraints at the beginning of the year were coming into play globally. Now with the Chilean meeting in November at the BCBS, we've seen a number of things, a number of regulators around the world start to push back. And for the first time, we're seeing banks, for the first time in a long time, really since the financial crisis, we're seeing banks' complaints being listened to because there's an emphasis on global growth, and there's an emphasis on restarting lending, and there's an emphasis on that all across the world, whether it's Japan or in Europe or in the United States.
So let's just stay on the markets just for a minute, and I want to dive back a little bit, right? So we talked about the stock market and some of the challenges within the bond market. Sanjay, what do you, from your perspective, what do you need to see rolling into that 2017 that is either going to become a signal of continued growth, at least from a market perspective, or is
looking at what the macroeconomic phenomenon is right now? I would first start with excess reserves in the system. In the US, I won't even talk about. So excess right now stand, as of now, the banks have put $2 trillion, 50% of our monetary base. And so we're looking at Mars and bubbles, that is an anomaly. With interest rates being so low, and if negative, you have to pay to keep excess reserves, which is happening. And so, so you start from there. And the
committee, a statement of financial institutions need to be jurisdictional economies.
So certainly, you've seen the regulators, for example, and you've seen a number, actually German come out, and as well as the EU come out and say, the leverage ratio, the rest of Basel IV, we need more time. We need more time to implement, and it needs to be fair. It needs to be fair between Europe and the United States. So again, this is the first time that banks are being listened to by the regulators, and so you are seeing that pushback. I think we've seen, for example, globally, BlackRock of the secondary liquidity in the fixed income space, and for the first time it's gone negative, which is a remarkable thing. I mean, you look at the fixed income market; it's basically an OTC market where you've lost your market makers, and that creates the potential for systemic risk because you now have increased potential volatility in the fixed income space. You have that liquidity risk is now being borne by the buy side, whereas in the past it was held by and intermediated by dealers. So I think there's a recognition globally, and this comes from the BCBS meeting, and that banks need to earn a return, albeit in a more rational, constrained environment.
Of the regulators, so and one at the Yale University on the Financial Crisis Global Forum in July, he talked about negative interest rates and the impact. But he finished his study by saying that yes, the impact of negative interest rates on bank profitability is negative, is an impact, but they have to figure out how to run their businesses. Which means that, so there is the banks going to the BCBS, and amazingly BCBS saying, now we hear you, because the political headwinds from both Europe and US, but at the same time there's some perspective by regulators that, okay, you got to figure this out. And so running a bank these days is enormously difficult.
So
just to add on to that, I think that one of the lessons, and this will get into some of the other things that we have to talk about, one of the lessons I think from all of that is that as a bank, you never really know what the headwinds are going to be, and you really have to be flexible. So we're looking at the Volcker Rule, right? So there's talk about the Volcker Rule coming back in, going back out after everybody's shut down the proprietary trading businesses in the U.S. Those are the kinds of things that models get thrown out, and then they need to come back. You need to develop an infrastructure of people, of processes, of systems, technology in banks that needs to be really flexible. these changes.
Right, so whether it's regulation stripped out tomorrow, there's elements of momentum in that marketplace. So, Sanjay, for you, where is the momentum, right, in terms of this new norm? It's great that, we're going to repeal things, but is this Basel ruling in terms of the European banks saying we need to be more competitive, is this a change? Is this a signal of a directional change globally for banks of a different momentum?
Yes. So from the talk that is coming out of Chile, and no formal announcement has been made, the talk that is, so some of the press releases, some of the press talk that has come out does talk about more cooperation, more listening, because think about this, Dodd-Frank was enacted without participation by the industry. They said, these are the rules, they wrote it in a hurry, they said, this is what it is, take it or leave it, and fact studies. And if we figure out that the impact is containable, then we give it to the banks and say, go figure. But now the regulators will be realizing that, and if there's, come of lending, they're not enough lending. Some at the same time, read us and have lower. So all the talk is about less regulation. Less regulation means that banks will be able to have more capital or more flexibility in lending or conducting their operations. However, the point that I want to come to is that change is expensive on society that we don't recognize. We always seem to be doing better. When Dodd-Frank came about, we thought that this is great, this is going to create a more stable financial system. But that comes at a cost. So it was the implementation cost, the regulators were busy with Dodd-Frank and all that, and Volcker rule. And now you're going to say, let's undo this. That undoing comes at a cost. Think about Brexit. Brexit, London is the second largest financial center in the world. And now suddenly banks are saying, well, we got to leave. Now, in this decade of surprises, it is possible that as banks start to lease space in Ireland or Paris or wherever else, they might have a referendum. Who knows? And that referendum will say, sorry, no Brexit. So even if it's improvement in regulation costly to the society. The second thing I think is what is driving the markets right now is this assumption of fiscal measures, that there will be more bridges and more tunnels and more infrastructure spending. I think that may be a stronger driver of these markets than regulation perhaps, because there's real dollars going into the economy, and there's some talk about Europe following that infrastructure spending as well. Because all the measures so far for the last 4 years or so have been monetary, negative interest rates, and excess reserves.
No, I think that's exactly right. I think the real momentum change here is that we've gone from pushing on a rope with monetary policy to now fiscal and hopefully private sector growth coming in. Private sector growth being driven by less regulation and fiscal growth driven by public partnerships. So I think that's...
And only 8 years ago, 9 years ago, business was supposed to be evil. I mean, there was a general notion that banks are evil, business is evil, let's do something, and everybody's expectant.
First time profitability
that's exactly right.
in years. So, let's talk about the new norm and the markets themselves. Right? So we talked about the banks, the infrastructure, but let's talk about elements of the market. And I think one of the more interesting trends right now is a growing risk appetite among institutions in terms of trying to find opportunities of return. And that's not just the banks themselves, because, well, obviously with Volcker we can't trade anymore, but on the buy side, investors, there's a change in sentiment right now. I mean, what are some of the challenges of a growing risk appetite and balanced in this kind of environment?
Well, so I think, so there is a growing risk appetite. I think that's a good thing. You're starting to see the animal spirits come back. And so I think that's going to drive a lot of the economy. There's a difference, though, between the new issue side that's I think continues to be robust and will probably continue to be robust for some time, and the secondary market side. So what that really means is that if the demand is on the buy side, and in the supply, the demand for loans, capital is going to be more and more on the corporate side. So that's all good. There's going to be less. There is less people. If something happens with Volcker or some of the LCR and SFR, some of those kind of regulations that crimp the capital, make prohibitive the capital demands on the trading side of the business, that secondary trading side of the business is going to be stuck and continue to be stuck. And so what that means is that the buy side is going to continue to wear not only the credit risk, but also the market risk for those instruments that they buy. And so that's something that I don't think the buy side has completely come around to.
Yep.
There's a lot of talk about all kind of trading systems where you have all the buyers in all the buy side in a particular segment or subsegment of the market, putting all their eggs in one basket and having a network where you basically go around the dealers and you share your trades, you match up your trades in between. For a variety of reasons, which we can talk about in a different time zone, that hasn't worked. But I think that's something to look forward to in 2017.
It's still a new paradigm, though. I mean, the fact that you may not have enough sort of market-making capacity by the broker-dealers or capital markets operations in the U.S., which used to be huge, and the prop trading desk as well. That might be a very significant sort of blow for liquidity.
Now, again, I think if there is a change in the Volcker rule, which is if there's a change in LSFR, those kinds of things help free up some of that.
And those for our viewers are the liquidity ratios.
Yes, I'm sorry, the liquidity coverage ratio and the net stable funding ratio.
Excellent. And so, let's turn a little bit in terms of the policy. Obviously, I think the banks are pushing back on the regulators. They're pushing back and saying we need to be competitive and whatnot. But politicians obviously want a more robust economy. It's hard to get elected when you don't have a robust economy. And we've had in our last conversation, and also there's a great paper authored by Sanjay and Jeb on FRTB post-Trump and looking at some key appointments. It's available on the Greenpoint website, so I encourage you all to take a look and download that as well. Great read. But I want to talk about, we've had two kind of key appointments now within Treasury, both arguably Goldman Sachs. So, I guess arguably you're getting the smartest guys in the room. So, Jeb, what's your breakdown on this?
So it's fascinating, right? So you not only have Steve Mnuchin as our new Treasury Secretary,
Not confirmed yet.
Not confirmed yet.
That's right.
And Gary Cohn, who doesn't need to be confirmed. You also have Steve Bannon there. So it is and you've got a lot of other Wall Street figures in there as well.
Business figures.
Business figures.
Yeah.
So it is interesting because you're seeing an infrastructure, a group that has long experience, but experience in the business community. So the New York, Tillerson comes from the business side. So it's not the normal Washington folks. If you go back and look at the kinds of things that we talked about, there is a certain amount of autonomy that the Federal Reserve has, particularly the Federal Reserve. The reality is at the moment that there's 500 seats, 2 of which are vacant, to be replaced by Trump. We have Chair Janet Yellen, whose chair position expires in just over a year. Her term doesn't expire for some time.
I mean, there's a lot of fact that the administration might come and say, we have a flat 10 times leverage, which is going to be negative or positive for the broker-dealers. And then liquidity. Right now there's a wall of cash sitting everywhere. That wall of cash is coming from the central bankers and with these
not being deployed. Yeah.
What happens if you're looking at 100 and 150 basis point shift in the 10-year around this time next year, or 200? What are we going to do? And so all of these surprises are there. So maintain flexibility and maintain hedged or readily hedgeable positions.
Well, Sanjay, I'd like to thank you so much. I take the elevator with you again. And Jeb, thank you so much for your insight. That brings us to the close of our half hour. Of course, we want to talk about the topics that you want to talk about. Please feel free to shoot me an email. Follow us on Twitter or at NX Analytics on LinkedIn. And check out our websites. The Trump Basel report that has been produced by Greenpoint is an excellent read, short read, brings you up to speed. Great holiday reading going into what your boss is going to be asking coming up for January 20th. Coming back into the new year, one of the exciting things we want to do is do this with more regularity. So your feedback for us is critical. Thank you so much, and have a great holiday and a great day.
Thank you.
Thanks, Jim.